Hello, it's Kevin here, founder of Dividend on Fire and creator of the Options Selling Roadmap course. In this video, we are going to be looking at a step-by-step walkthrough of an options strategy called the options wheel. This is a strategy that is big in the US, but hardly known or talked about here in the UK. I'll show you an example of the options wheel strategy on a hypothetical UK utility stock, and then at the end of the video, introduce you to all the UK stocks that you can sell options on. First then, meet Steve. Steve is our investor, and he's very much interested in a company called ABC PLC, which is currently trading at 500 pence. So ABC PLC is a utility company. It's a pretty boring company. It runs along pretty steadily and pays out a reliable dividend. So from an income investor's point of view, it's a pretty good investment. Steve likes the look of them long term. So one of the first things he does as an investor is do some fundamental analysis. So he looks at the fundamentals of the company. After reviewing the numbers, Steve thinks it's fairly valued. He then looks at what the analysts are saying about it. Analysts are the professional people who monitor and investigate shares on a daily basis, and that information is surprisingly easily available to get. He looks at their consensus, and they have given it a price target that is higher than the current share price, which suggests that it's fairly valued as well. He's also attracted by the 4% dividend yield. If he invested £1,000 in shares, he would be getting £40 a year just in dividends. That's pretty good all on its own. And importantly, that dividend is covered 1.6 times. So that's the fundamental considerations checked. Next, we have a look at the technical considerations. Steve wants to know what is the price actually doing at the moment, so he might well look at the charts. And this particular chart for ABC looks pretty good. The stock is ambling along nicely, it goes up, it goes down, but it's not in any sort of downtrend. No obvious panic signals are flashing, so Steve decides he likes the look of ABC, and he likes the look of it at 500 pence. He's happy to buy the shares at that price with that dividend deal. And indeed, many investors would just do that. But as savvy options sellers, we're not going to do that. We're going to go a stage further. We're going to sell or write a put option. So Steve checks the puts in an options chain with his online broker, and he's spotted there is a put with a strike price of 490 pence that expires in 30 days. Now, what the strike price means is that is the price that Steve will pay for the shares that are currently trading at 500 pence if the option is exercised. And the option will be exercised if the price drops below 490 pence. The expiration date is the date the option ceases to exist. So if it's a 1-month contract, in 1 month, that option will cease to exist, and its expiration date is whatever the date is in a month. So here's the good bit. Steve can sell this put and get paid £100. That's £100 that will go straight into his broker account. In return for that, he has a commitment to buy 1,000 shares of ABC at 490 pence each, or £4,900 in total. In the UK, one options contract equals 1,000 shares, whereas US options, one contract equals 100 shares. In this example, we are leaving out commissions to keep things simple, but it would be around £1.70 or thereabouts. So Steve is committing to buy the shares for 10 pence cheaper than they're currently trading at. And that works out to a yield of just over 2% for 1 month. So you're going to get 2% of the share price of the money that you have to commit for a 1-month commitment. Now you can do the maths and multiply that up over a year and sort of start to see the potential here when selling options. As I said, this is a slightly simplistic example, but those are perfectly valid numbers we're talking about. When I sell options on UK equities, this is the sort of annualized return I am aiming to achieve on every trade I enter. So back to our example, Steve looks at it and says, that looks great, and he sells the put option. Fantastic. So what happens next? Well, not a great deal to be honest. It's a put with a 1-month expiration date. So for a month, nothing is going to happen. You can just sit back, play golf, go to the gym, do a furniture making course. This is my new avocation, or whatever else you want to do. At the end of the month, when the expiration date comes, and the expiration date is always on the 3rd Friday of the month, once trading finishes on that day, there's only one of two situations that can exist. The share price is either above or below the strike price. And if you remember, the strike price was 490 pence. So if the share price is above 490 pence, the put will expire worthless. If you buy a put option, it allows you to sell shares at a certain price. So whoever owns that put has no reason to sell their shares at 490 pence if the price is above 490 pence. They were better off just selling their shares in the open market. Therefore, it expires worthless. That's it. You keep the £100, you're done. You can then simply repeat the process next month and the following month, or the next 2 months, or the next 3 months, or whatever you decide. You just keep repeating the process. The alternative scenario is the share prices drop below 490 pence. So in this case, whoever owns the put will say to themselves, well, instead of me selling my shares in the open market at, say, 485 pence, I can use Steve's put and sell them to him for 490 pence. That is the trade-off that Steve has taken. So in that case, the put would be exercised and Steve is obligated to buy the shares for 490 pence each. Now, on the face of it, you may go, oh, that doesn't sound good. But it's exactly the scenario that we looked at in the first place. In fact, it's better. Steve was keen to buy those shares at 500 pence. He's now bought them at 490 pence, and he's being paid £100 for the privilege. That's a pretty good outcome. In fact, both those outcomes are good. So, assuming that Steve's put is exercised, he's now the proud owner of 1,000 shares of ABC plc. That's not a bad position to be in. He's pocketed the original put premium, the £100. He now owns the shares, so he may also bag himself a dividend. Now, you get yourself a dividend if you own the shares when they go ex-dividend. It may happen, it may not. It depends on how long you own the shares. If it does, it's great. And the other thing Steve can do, because he now owns 1,000 shares, is look to sell covered calls. He's moving on to the next stage of the options wheel cycle. So that's exactly what Steve decides to do. So let's assume that ABC shares are now trading at 485 pence. So that's 5 pence less than Steve paid for them using the put. Steve has a look at the option chain. He spots he can sell a 1-month call with a strike price of 500 pence. Now the strike price in this case on a call is a price that Steve will be obligated to sell his shares for if the call is exercised. And the call will be exercised if the share price goes above 500 pence. Now 500 pence is 10 pence more than he paid for the shares. In return for selling this call, he's obligating himself to sell the shares for 10 pence more than he paid for them. That's not a bad situation to be in, and he can get £75 for selling this call. That turns out to be a yield of 1.5% for a month, so he's going to get paid £75 for this obligation of selling the shares for more than he paid for them. Sounds pretty good. Steve decides to pull the trigger and sell the call. And again, what next? Well, in a very similar way to the put, not a great deal. He sold a 1-month contract, a 1-month call contract, and he simply has to sit back and wait for that to expire. At the end of the month, the share price is either below 500 pence, so it may well have gone up to 498 pence, for example, in which case the call will expire worthless. Remember, the owner of the call has the right to buy the shares at 500 pence. So if the shares are trading at less than 500 pence, it makes no sense for them to do that. They could just go into the market and buy them for 498 pence, for example. So the call expires worthless. That's great. You get to keep the premium, and you can just rinse and repeat by selling another covered call the next month out. You still own the shares, so you still have every chance of picking up a dividend down the line, and you're bringing in extra premium for selling the call. The other outcome is that the share price has risen above 500 pence, in which case the call will be exercised, because somebody who owns that call can now buy shares for 500 pence instead of, say, 510 pence they're trading at that point. That's the rub with this strategy. Steve is obligated to sell his shares for 500 pence each. But that's hardly a big deal. He's made 10 pence each on his 1,000 shares, as well as being paid for selling the call in the first place. And then what happens? Well, we've gone all the way around the wheel, and we're right back at the beginning. It's time to sell another put option on ABC, or find a different stock and sell another put. That's why we call it the wheel option strategy. We just go round and round, and of course, in the real world, you'll have more than one stock on the go. You might have a dozen or half a dozen, so this cycle just goes round and round. Now things in the real world seldom work quite as smoothly as that, but I think you get the idea of how this all fits together. Selling options are a great way to generate extra income that gets paid directly into your brokerage account, typically on the same day. Dividend on Fire is about creating your own synthetic dividend on any stock that has an options chain. You don't have to wait for dividends to roll in, you can create your own every month selling options. The UK options market is quite limited versus the US, but there are around 90 FTSE 100 companies that you can sell options on. I have created a free spreadsheet with all of these stocks on. You can find this free resource in the description below. As always, dear listener, take care and happy investing.